Hi everyone. Today I am going to share a new topic about business valuation. How to get a best value for the seller. It is quite natural that when a person sells his asset or his business, he wants to get the maximum price, the best value for his business. For selling his business, then he needs to find a fair price. What is the best price he can get from the investor or the buyer? As the buyers are not fools, the seller has to put a fair price. Seller has to put forward a reasonable price for the business he is going to give up. Then only he can find a good buyer. But how to find a fair value of the business, or how to put a best value while seeking investors, either for 100% stake or a part of the business. As business involves many aspects, the revenue it earns, the expenses it incurred, the margin it is left with, the assets it holds, the liabilities it owes to various third party stakeholders, and the equity remains with the company. The audited financial statements provide these values, but it is based on mainly a cost basis or historical cost method. When one adopts cost basis, restrictive principles are involved, so conservatism or prudence method. It is value based on cost incurred and not the market the business can demand. Actually, a lot more aspects to be considered for market value of the business when compared to the value reflecting in the audited financial statements. As in the audited financial statements, many aspects are not considering, mainly for the intangible assets, say employee rights, brand value, the goodwill it can fetch, the customer rights, distribution rights. All these assets are very important and can contribute to majority of the earnings or value addition the business can bring in future. Sometimes the market value of the fixed assets are much higher than the book value of the assets. The company may be having special licenses and all, and the audited financials are not reflecting all these intangible assets and its values. The audited financial statements fail to address all these assets, and the book value of the assets may be only a small portion of the real value of the business. Ultimately, when a buyer is going to invest in a business, his focus is how much he can earn in the future, how much cash flow the business can generate in future. The buyer is interested to see when his investment can be recovered in the future and what is the value addition he can bring into his own business. In the same manner, the seller should also have the confidence to state that his business can easily bring this much cash flows and the margins in future, so that he can demand a fair price for his business. Thus, the seller could be in a position to convince the buyer that by investing in his business, a reasonable or higher than the expected return can be made by the investor in future. From a seller's perspective, the highest value he can demand from the buyer is the best value for him. For arriving the business valuation, there are various methods: discounted cash flow method, relative or comparable companies method, adjusted value method, or option pricing method, etc. For small and medium entities where cash flows can be predicted without much uncertainty, discounted cash flow method will be a priority while making the valuation. Wherever possible, valuation based on market multiples can also be utilized or employed when comparable market data is available. The best way is to adopt a valuation based on two or more methods by giving due weightage to each method, then arrive a fair price, giving room for reasonable negotiation. Hope this information give some insight from a seller's perspective for the business valuation. Thank you.